What's up, guys? Dan here for Pekoe Mortgages. Today, I want to talk about fixed and variable rate mortgages. Inevitably, if you've been looking for a house or you already have one, you'd be faced with the question of whether or not you want to go fixed or variable. And even if you haven't, recently in the news, it's really been making the rounds with interest rates going up. We're in the spring market here, 2021. It's been a pretty crazy market to begin with, but let's unpackage fixed and variable. I want to explain a little bit about the mechanics behind it. So you've probably seen in the news that fixed rates have gone up, or they've just said rates have gone up in general. Let's look at that and see what is going on. Fixed rate mortgages is not going to change. That interest rate stays the same for the duration of your term. You compare that to a variable rate mortgage where that rate can go up and down, which can either change your payments monthly or bi-weekly or whatever you have as your payment frequency, or it just changes the ratio of interest and principal that you're paying. So as the interest rate goes up, you're paying more interest. As the interest rate goes down, you're paying less interest on the principal and interest portion of your mortgage. So that's basically fixed and variable rate mortgages. I am very strongly in the variable rate camp for a few reasons. Historically, it's outperformed a fixed rate mortgage, and the penalties are a heck of a lot cheaper. So let's unpackage this and see what's going on. Okay, so what you're seeing here, this is coming directly from the Bank of Canada, and I've just gone into the selected bond yield. So the bond yield is really what is dictating the interest rates for fixed rate mortgages. As you can see, historically, it's been a lot higher. And then in 2020, it's dipped down. And let's zoom in here a little bit, just so we can get an idea. You can pay more attention to the pink. And what I'll do is I'll just deselect a bunch of these. These are yields for different terms, and we are just going to focus in on the 5-year yield. If you take a look here, guys, you'll see it's been relatively steady, and then we get this blip right around the beginning of February, and that blip has obviously gone up. So rates have gone up with the bond yield. Basically, there's an inverse relationship with bond yield and the bond prices. So what's going on here? Well, in the US, the Federal Reserve Chairman Powell had indicated that inflation's not a concern, and inflation is essentially the kryptonite for bond yields. So everyone just kind of decided to exit the bond market, and as bond markets have taken a hit, so too have the prices. So as the bond price goes down, that bond yield goes up, and as you can see on my little chart here, this yield has spiked quite a bit. So in response, banks have increased the 5-year fixed rate to correspond with this increase in the bond yield. That's really the mechanism behind fixed rate mortgages. Now, if we jump into some shorter term investments, so T-bills are one of them, so treasury bill yields, let's take a look at this and see what's going on. You can see from 2005 there's a big drop off here in treasury bills, and it's maintained relatively low rates over here. We haven't seen too much of a climb, and this is what actually dictates that spread on a variable rate mortgage. So your variable rate mortgages are always tied to that Bank of Canada, the overnight lending rate. Right now, prime is sitting at 2.45%. And you'll see an advertised rate maybe of prime minus 100 basis points. What that means is you're paying a rate of 100 basis points or 1% discount on that prime rate. So if prime is sitting at 2.45, you get 1.45. And as you can see with the treasury bill yields here, so these short-term yields, 3 months, we're looking at 6-month T-bills. All of these short ones here dictate where variable rates are going to go. So even though we might not see a change in the overnight lending rate, that spread, that discount we get, the 100 basis points, that is going to be dictated by this little guy here. So if these start to trend upwards, then that means we can expect a less of a discount on our variable rate. So instead of prime minus 100 basis points, we might start seeing prime minus 75 basis points. What does that mean for you guys? Well, let's look at it right now. Fixed rates are sitting about 50 or 60 basis points higher than a variable rate mortgage. So if we're just looking at that discount on a $500,000 mortgage, you're getting about $2,000 in savings by going variable. But you're thinking, well, Dan, we don't know if the rates are going to go up. You're totally right. We don't know if rates are going to go up. And that's one of the risks with the variable. But if we look at all of the economic indicators and what's going on here in Canada, we can safely presume that we're not seeing the returns that we should be getting. So most economists have predicted that rates will stay relatively low for the next couple of years, at least. So let's assume they do stay low. Well, what happens? Our interest rate, our variable interest rate, if we assume a savings of $2,000 a year, in 2 years, that's $4,000 in savings. Not only will interest rates have to go up on a variable rate, if it went up 50 basis points, we'd be where fixed rates are today. That isn't very likely, and for it to go even further up, so say it climbs 1%, all of a sudden our variable's at 2.45. There's still a lot of catch-up that has to happen there, and by most accounts, staying into a variable rate mortgage for the duration of your term is actually going to put you ahead when you look at the cost savings. There's some options you can look at too, convertible mortgages, where basically the variable can be locked into a fix down the road if you choose to do that. But I always recommend folks go variable. You've got a few things. You've got the savings on the interest rate, but then you also have the savings on that break penalty. And that's really key because the majority of Canadians will make a change to their mortgage in the first 5 years. So keep that in mind, guys. Again, if you want more information on this, do reach out. Happy to answer your questions. Like, subscribe, all that sort of good stuff if you like seeing what I'm talking about. And if you need help on anything, reach out.